Are you over 65 and worried about a massive tax bill landing on your doorstep? Stay with me because what I'm about to reveal could save you thousands of pounds. If you've received any communication from HMRC recently, or if you're approaching retirement age, this video might be the most important thing you watch all year. Hello, and welcome back to Smart Pension UK, where we cut through the confusion and bring you the straight facts about your money, your pension, and your taxes. I'm here to help you navigate the complex world of retirement finances, and today we're tackling something that's causing serious concern for thousands of pensioners across the country. Now, before we dive in, let me be absolutely clear about something. There's been a lot of misleading information floating around about HMRC introducing some kind of new £2,500 tax charge specifically for over 65s after November. Let's set the record straight right now. HMRC hasn't introduced a brand new tax that specifically targets pensioners. But, and this is a big but, there are very real reasons why many people over 65 are suddenly facing unexpected tax bills of this size or even larger, and understanding why this is happening is absolutely crucial. So what's really going on? Why are so many pensioners finding themselves with shocking tax demands? Let me walk you through the actual reasons this is happening, and more importantly, what you need to do about it. First, let's talk about the state pension increase and how it's caught thousands of people off guard. The state pension has been rising thanks to the triple lock guarantee. For the current tax year, the full new state pension is over £11,500 annually. Now, your personal allowance, that's the amount you can earn before paying any income tax, is £12,570. Sounds like there's plenty of room, right? Wrong. Here's where people get caught out. If you're receiving the state pension plus any other income, maybe a small private pension, perhaps some part-time work earnings, or even certain state benefits, you can very easily tip over that personal allowance threshold. And here's the kicker. Many pensioners don't realize they've crossed that line until HMRC sends them a tax bill for all the underpaid tax from the previous year. Let me give you a real-world example. Imagine you're receiving £10,000 from your state pension, and you've got a small private pension paying you £4,000 a year. That's £14,000 total income. You've exceeded your personal allowance by £1,430. At the basic rate of 20%, that's £286 in tax you owe. But what if you didn't have the right tax code set up? What if HMRC didn't know about all your income sources? Suddenly, you could owe tax for multiple years, and that's where these larger bills come from. The second major issue is pension tax codes and pay problems. This is huge and affects far more people than you'd think. When you start receiving your state pension, HMRC is supposed to adjust your tax codes automatically, but the system isn't perfect. Far from it, actually. Here's what commonly happens. You might be receiving multiple pensions, your state pension, maybe an old workplace pension, perhaps a personal pension you set up years ago. Each one should have a tax code, and together they should use up your personal allowance efficiently. But if the codes aren't set correctly, you might not be paying enough tax through the year. Then comes the reconciliation, usually after the tax year ends, and boom, you get a bill for the shortfall. Even worse, some people have emergency tax codes applied when they first access their pension. These codes can mean you're either paying too much tax, which you'll eventually get back, or too little, which means a bill later. And because HMRC's systems don't always communicate perfectly between different pension providers, errors slip through. Now, the third issue, and this one's particularly nasty, is something called the high-income child benefit charge, but it can affect grandparents too. If you're still working past 65 or you have significant pension income and your household is claiming child benefit, perhaps for grandchildren you're caring for, you need to know about this. If your individual income exceeds £50,000, you have to start paying back the child benefit through your tax return. This catches people completely by surprise because they don't realize it applies to them. Let's talk about the marriage allowance and other relief people are missing. Here's some good news in all of this. If you're married or in a civil partnership and one of you earns less than the personal allowance while the other is a basic rate taxpayer, you can transfer 10% of your personal allowance to your partner. That's worth up to £252 a year in reduced tax. Thousands of eligible couples aren't claiming this, which means they're paying more tax than they need to. Similarly, many pensioners are entitled to tax relief on things like maintenance payments if you were born before April 1935, or expenses related to work if you're still employed. Not claiming these means you're overpaying, and that can add up to significant amounts over several years. The fifth factor is savings and investment income that people forget about. When you retire, you might have more money in savings accounts, especially if you've taken a pension lump sum. The interest on those savings counts as income. The same goes for dividends from investments. There are allowances for both, the personal savings allowance and the dividend allowance, but these have been cut in recent years. For basic rate taxpayers, you can earn £500 in savings interest tax-free, but if you're a higher rate taxpayer, it's only £250. Many pensioners don't realize that the interest they're earning has pushed them into a higher tax bracket or created a tax liability they weren't expecting. Then HMRC catches up with you, sometimes years later, and demands the unpaid tax all at once. Now, what about this November deadline that's got people worried? Here's the truth. There isn't a specific November deadline that creates a £2,500 charge. However, November is significant in the tax calendar. It's when HMRC typically sends out notices about underpaid tax from the previous tax year, which ended in April. These are called PA 800 forms or simple assessment letters. If you owe less than £3,000, HMRC will usually try to collect it by adjusting your tax code for the current year. If you owe more, they'll ask for payment, often in a lump sum or through a payment plan. The autumn months are also when HMRC ramps up compliance activities. They're checking records, matching data from pension providers, banks, and employers, and sending out queries and demands to people whose tax doesn't add up. So if you're going to hear about a tax problem, November through January is prime time for those letters to arrive. So what should you actually do about all of this? Let me give you a clear action plan. First, check your tax code immediately. You can find it on any payslip, pension statement, or by logging into your personal tax account on the HMRC website. Your tax code should normally be 1270L for this tax year if you're entitled to the full personal allowance. If it's anything else, especially if it includes K, BR, or NT, you need to find out why. Second, if you receive multiple pensions or have other income, make sure HMRC knows about all of it. Don't assume they do. You can update your information through your personal tax account or by calling HMRC directly. Yes, the wait times can be long, but it's worth it to avoid a big bill later. Third, if you've received a tax demand that you think is wrong, don't ignore it, but don't panic and pay it immediately either. You have the right to query it. Contact HMRC, ask for a breakdown, and if necessary, request more time to pay or set up a payment plan. They're usually quite reasonable if you engage with them proactively. Fourth, consider whether you should be filing a self-assessment tax return. If you have untaxed income, if you're self-employed, if you have rental income, or if your tax affairs are complex, registering for self-assessment gives you much more control. You declare everything yourself and there are fewer nasty surprises. Fifth, claim everything you're entitled to. Check if you qualify for marriage allowance, married couples allowance, if one of you was born before April 1935, or any other reliefs. These can significantly reduce your tax bill. And here's something that not enough people do. Keep good records. Keep copies of all your pension statements, bank statements showing interest earned, and any correspondence from HM Revenue and Customs. If there's ever a dispute, having the documentation makes everything so much easier. Now let's address some of the myths and misinformation that's out there. Myth number 1, HMRC is targeting pensioners with new taxes. False. The tax rules haven't fundamentally changed. What has changed is that the state pension has increased while personal allowances have been frozen since 2021, which means more pensioners are becoming taxpayers. HMRC is also getting better at data matching, so they're catching discrepancies they might have missed before. Myth number 2, you don't have to pay tax once you're retired. Absolutely false. Retirement doesn't exempt you from tax. If your total income from all sources exceeds your personal allowance, you pay tax just like everyone else. The state pension itself is taxable income, though it's paid before taxes deducted. Myth number 3, if you haven't heard from HMRC, your tax must be fine. Unfortunately, not true. HMRC can take time to process information and spot problems. Sometimes they're reviewing returns and data from 2 or 3 years ago. Just because you haven't heard from them doesn't mean everything's in order. Let me share what's likely to happen in the coming months and years. The government has been freezing tax thresholds while pensions and inflation have been rising. This is called fiscal drag, and it means more and more pensioners will find themselves paying tax who never did before. The state pension is projected to keep rising, potentially reaching the personal allowance threshold entirely within a few years. When that happens, almost everyone receiving a full state pension plus any other income at all will be a taxpayer. Additionally, HM Revenue and Customs is investing heavily in automated systems and data matching. They're getting information directly from pension providers, banks, and other sources. This means they'll spot discrepancies faster and more accurately. If you're already dealing with a tax bill you weren't expecting, remember that HMRC does have hardship provisions. If paying the full amount immediately would cause you genuine financial difficulty, you can request a payment plan. They call it time to pay arrangement. You'll need to explain your circumstances and propose a realistic payment schedule. One more thing I want to mention: be very wary of scams. Unfortunately, tax demands and pension concerns make people vulnerable to fraudsters. HMRC will never contact you out of the blue by phone demanding immediate payment, especially not by threatening arrest or asking for payment in gift cards or cryptocurrency. If you receive suspicious contact claiming to be from HM Revenue and Customs, don't engage with it. Contact HM Revenue and Customs directly using the phone number from their official website. The bottom line is this: the 2,500 pound tax charge that's being talked about isn't a new specific tax on over 65s. What's really happening is that a perfect storm of frozen allowances, rising pensions, better HMRC data systems, and common tax code errors is catching thousands of pensioners with unexpected bills. But here's the empowering part: you're not helpless in this situation. By understanding how the system works, checking your tax codes, making sure HMRC has accurate information about all your income, and claiming all the reliefs and allowances you're entitled to, you can avoid these nasty surprises. So there you have it. The real story behind these tax charges that are worrying so many over 65s. It's not a conspiracy, it's not a new punitive tax, but it is a genuine issue affecting real people. If you found this video helpful, please give it a thumbs up and make sure you're subscribed to Smart Pension UK. Hit that notification bell so you never miss our videos about pensions, taxes, benefits, and everything else that affects your retirement finances. Drop a comment below if you've been affected by an unexpected tax bill. I read every comment, and your experiences help other viewers. Remember, you're not alone in navigating this. Take care of your finances, stay informed, and I'll see you in the next video. This is Smart Pension UK, helping you make the most of your retirement one video at a time.